A very good afternoon to you, Addington. Well, the first question would be, why should people be investing in food producers in Nigeria?
I think, as you've just mentioned, when you look at Nigeria, it's one of the biggest economies by population in Africa. You're looking at 163 million people. So that obviously supports the volume story in Africa. And if you're also looking at the consumer spend, has been growing strongly in the past, I think around 14%. It's now forecast to grow at about 18.5% going into 2016. So obviously that supports the demand side in terms of the food producers and also other consumer names. If you're talking of the brewery sector, the food manufacturers, which are your likes of Nestle's. Then you have the commodity plays, which is your flour mills of Nigeria, Dangote Sugar and Dangote Flour. So we basically think that for investors who are looking at a play for the population story, for the GDP growth story, Nigeria is one of the interesting opportunities in Africa at this point in time.
And what would be the risk for the sector going forward? You've painted a positive picture about the sector, but there should be some sort of risk there.
Yeah, I guess, I mean, every investment has got a risk. I think the first thing that you'll be looking at in Nigeria right now, we're all aware that in February this year, they removed the fuel subsidy. That obviously affects the consumer spend in terms of their monthly budgets. That means the fuel cost is significantly gone up. And secondly, we have had some disturbance on the northern part of Nigeria from the Boko Haram attacks. Obviously, that puts some security risks in terms of the companies that operate in those regions, which are basically the flour milling companies, the likes of Dangote Flour and Flour Mills of Nigeria. But obviously things like this political unrest is something that is not uncommon in Africa. Hopefully this can be resolved. I think the Nigerian government has been working hard to make sure that there's some stability that is brought into that region.
Yeah, Mike?
Excellent. No, that's a good point. And I think you made a good analysis of what the risks are to the country as a whole. But just in terms of the consumer sector, most of those names have had a really big, strong run on the market in the last couple of months. Now, a lot of questions I get, and I'm sure you get a lot as well, is have they not run too far? Is there not some pullback in these names? Your Nigerian breweries trade at 125 or whatever it is now.
I guess that's a very true observation. If you look at the likes of Unilever, this year it has gone up by 30% year to date, one of the best performing consumer goods companies. But what we are actually looking at right now, there are other names that we think could be growing quite strongly, and this speaks to the likes of Nestle. We think Nestle is growing faster in terms of earnings compared to Unilever. So while you might have other names that look relatively expensive, you might need to rotate out of the likes maybe of Unilever. We have a sell recommendation of Unilever. We think investors should be buying into Nestle. So that's true, there are some names that look relatively expensive, but we think if you look on a forward basis, if you look at the likes of Nestle, it's going to be trading on a forward about 15 times, while Unilever is going to be trading at a forward of about 21 times. So you can actually trade out of Unilever, get into Nestle.
Okay, excellent. And then, sorry, I mean, again, our clients, your clients are typically foreign, and that's obviously the target base, but what are the local funds or the local PFAs thinking about the consumer story? Because obviously for foreigners, you buy the story, you hear about the population and the rising middle class. But what is the local thought on that?
I think when you look at the local fund managers, they basically are stuck in between being in the equities or in the fixed income space. And obviously, given that the fixed income space is yielding higher compared to equities, most of the PFAs are actually holding fixed income. But generally, in terms of looking at the consumer space, some of the guys prefer the lowly valued companies like UAC, the likes of Flour Mills Nigeria. So they would actually be inclined to buy those companies compared to the multinationals, which are seen as relatively expensive. But in our view as African Alliance, we probably think that the multinationals such as Nestle are actually cheaper on a forward basis. They put in new capacity online, which should be able to drive revenues going forward. And we've seen Nestle in the past, one of the few businesses in Nigeria that has managed to grow their revenues above nominal GDP. So going back to what you've just said, Mark, that most of these international investors that are coming into these markets, they're buying the big story, GDP growth, population growth, but it's been filtering into the numbers. Just look at Nestle. In the past 5 years, one of the best performing counters grown by about 22% per annum, followed by the likes of NB, Guinness. So I think the easiest story, obviously in the short to medium term, you might have to pick which one is cheaper, and for the local fund manager, his benchmark is versus his peers. So if he's underweight fixed income, he might underperform. But overall, we probably think that there is a story going forward.
Looking at a company like Dangote Flour Mills, we know that Tiger Brands is going to come in with an acquisition of about 63.4%. You touched a lot on Nestle. How about a company like Dangote Flour Mills? Positive for them in terms of Tiger Brands?
I think Dangote Flour is one of our best picks in the consumer sectors in Nigeria. We probably think that with Tiger Brands coming in, that's going to be a game changer. First of all, if you look at the challenges that Dangote Flour has, is probably extraction rates. They have a lot of excess capacity. So you probably think with the expertise that Tiger Brands has. It has shown that in South Africa, their grains business has been doing very well. We think they can turn around Dangote Flour. It had a couple of issues. I think management quality was one of the issues in Dangote Flour. We probably think with Tiger Brands coming in, that could probably change. A lot of, I think, industrial bakers complained about the quality of flour that came out of Dangote. But right now, with Tiger Brands coming in, we probably think they'll work on the quality. So over the long term, we think Dangote Flour is an interesting long-term play, I think, for investors who can actually stick it out for the next 5-6 years. So it will be an interesting opportunity for investors.
You know, and related to that, obviously Tiger Brands is not technically a new participant or competitor. I mean, are there any new entrants into these sectors, your brewers, etc., that could potentially, you know, take market share away from some of the ones we know, the Nigerian brewers, the Nestle's, etc.?
I don't think the threat of new entrants is quite significant at this point in time. If you look, first of all, at the commodity plays, there are a couple of barriers that stop big companies coming into Nigeria. For example, you need port access. Right now, if you look at Dangote Flour Mills of Nigeria, they have port concessions for the next 25 years. So whoever wants to come in and compete with these guys must have port access. So we do not see that happening in the short term. But if you look in other sectors, in other categories, which could be the brewers, maybe we might have 1 or 2 companies consolidating, or maybe we might have in the multinationals, we might see the likes of maybe Danone coming into Nigeria because they don't have a presence in Nigeria. But at this point in time, it's a market where the current players such as Nestle, they have significant market shares in the products that they do produce in Nigeria. For example, in the spices category, Maggi is the market leader with 40% market share. So whoever is going to come in is probably going to have a smaller piece of the cake. So we do not see the threat of new entrants being something that is quite significant in the medium term.
Okay, excellent.
So the branded consumer companies look more attractive than any other at this stage?
I think the branded consumer companies look quite attractive because there are a couple of steps that they've taken to probably capture the short-term opportunity and the long-term growth prospects. So right now, in the short term, most of these companies cannot pass on prices to consumers, so they've been innovative in terms of pack sizes, which obviously hedges their margins. Then also, when you look at the long term, they've been increasing their capacity. As the population grows, they will be able to utilize this capacity. And we're thinking the branded consumers are the better play compared to the commodities. And also, if you just look at the forecasting of these companies, you relatively have a better forecasting accuracy in the Nestle's, Unilever's, because they have a sort of like predictable cost structure. But if you look at the commodity plays, the cost structure is predominantly soft commodities, which are determined by the international prices. So that tends to have a significant impact in your cost of sales. So we probably think that the branded consumers are better compared to the commodity plays.
Well, that's where we have to leave it. Thank you so much for joining me, gentlemen. That was Addington Jerahuni. He's from African Alliance Securities. And a very big thank you to our guest host, Mike Barnes, Head of Sales and Trading at Securities Africa.